Thanks for tuning in to Talking Point. I'm your host, Niraj Shah. Our guest today has written this very interesting note wherein he's talking about how um, multiple multiple players in the Indian investing landscape are caught between the rock and a hard place. And these players range from the government to other policymakers to maybe the investors as well. Is Ganeshram Jayaraman himself, who's the MD and head of Avendus Spark Institutional Equities, caught between the rock and a hard place when he's answering large institutions about what to do? Let's ask him. He joins in right now on the show. Ganeshram, always good having you. Thanks for taking the time out. Are you caught between the rock and a hard place, Ganeshram?
Morning, Neeraj. Always good speaking to you. Yeah, so of course we are caught because the challenge with the markets today is, as we had mentioned in the note, there are plenty of conundrums which are there, right? On one hand, the big picture on India is still very good, but the multiples are quite expensive, and there can be earnings challenges. And within the portfolio construct, we have been very decisive over the last 3 years, maybe about 3.5 years, pretty much from COVID onwards, that the tilt of the portfolio decisively should be towards cyclicals, towards industrials, real estate, financials, autos, and the domestic cyclicals, manufacturing. They've been the clear decisive tilt, and away from IT, away from consumption, okay, which and even consumer financials. That has been a very very clairvoyant call over the last 3-4 years. Should you change that? Is the first question, and that question is coming because we think the policymakers, the government will have questions asked due to the election mandate, and not just election mandate, but even prior to that, you had questions around the nature of consumer recovery. Last 18 months, and including in our assessment based on channel checks, even including the June quarter, it's now 21 months where consumption has been slowing down and the K-shaped recovery has been impacting mass consumption. Now, will the nature of election mandate, will it make the policymakers change their stance? And I'll give you some numbers. Over the last 4 years, government's capital expenditure has tripled on not a low base, it's tripled. Whereas government's subsidies, or you can call all the rural spend, that's actually been flat. Okay, so this has impacted the nature of recovery, and clear. You've seen multi-baggers in defense, railways, even cables, all the industrials stocks which benefited from government capex, but consumer stocks have gone nowhere over the last 3 years. Should you change? Will the government's policymakers change their stance? What will be the second order derived impact of that? Will it lead to inflation? Okay, because we have always seen in India, if there is a government push towards consumption, or trying to get the mass end of the consumers pyramid there, if you take their income profiles higher, it invariably leads to inflation. Then how will central bank behave, react to that? Okay, so that's why we called this whole note as caught between a rock and a hard place, and that has implications for portfolio managers and fund managers, or anyone managing money into the markets. Okay, clearly, because how should the portfolio be constructed with not just next 6 months or 12 months, but over the next 36-month view? What should be the decisive tilt? And it's not as black and white as we would have wanted it to be.
So, Ganesh, what do you think, if indeed, as your note says, that there is a middle path with a bias towards fiscal consolidation, what's the resultant impact from a equity watcher's perspective on portfolio and on multiples?
I think there's another layer to it, which is private capex cycle. Okay? We think private capex cycle will pick up. It has been a government capex cycle, property capex cycle, but not yet a private capex cycle. We think that will pick up over the next 18 to 24 months. Maybe even in the next 6 to 9 months it can start, but it will start with PSU companies, okay, be it in refineries or steel. You will see private PSU companies beginning Capex. I think it will go into the private sector Capex next year, okay, and that will bring supply. So if you look at demand, supply, earnings, valuation, there are four drivers for stock prices to do well over the not over the medium term, say maybe 24 to 36 months. Okay, and when you look at it, we think supply will go up. We think demand can remain, especially on the consumption side. We think it can remain sluggish. We think valuations can moderate because let's take an example of say paints stocks. Okay, now it was a cozy oligopoly club for 10 years or more. Okay, one new entrant was coming with a reasonably large capex. The incumbents' earnings have shown no problem. In fact, over the last 3 years, their earnings have grown 75% cumulatively. But the stocks have gone nowhere because market knows that if you're an oligopoly business characteristic of a sector starts undergoing a change, it can have impact on margins, pricing power, market share, operating leverage. It will come with a lag, but markets don't wait for earnings. In a well discounted market like India, well understood economy globally by institutional investors, people will be early. And that's why my fear is that there can be an angle, and add the angle of the election mandate led, not just mandate, as I said, it was coming and over the last few maybe for few quarters, this character of consumption will need some kind of intervention and to kind of channel the flows and the economy in a different direction. What should we do? Should we be too early? Can we be too late? Those are real questions to be had, and implications of all of this on earnings will come maybe not the next six, maybe not 2 quarters, but thereafter.
Okay, Ganeshram, so based on your assessment of where within this private sector capex will the first inkling show? Because, you know, we've seen select industries do this. It's not been uniform, but, you know, data centers, new age power, etc. There the capex is happening at the private end too. Within the others, where is it that you believe we hitherto haven't seen meaningful private sector capex, but we are likely to see that? I mean, based on either capacity utilization levels or the industry turning or what have you. Private sector specifically.
Yeah, power, steel, maybe semiconductors.
But that's happening, right, as we speak, any which ways.
Power has not been happening. Steel's not been happening. Last many years, cement has been happening. Semiconductors announcements have come. We think that announcements have not yet. The rubber has not hit the road yet. A capital goods company has still not seen any order book coming from any of the announced semiconductor projects. So have we all baked it into our? Have we built a semiconductor industry-led demand potential for a capital goods company, a transformer or a voltage related management companies? No. Okay, we have not penciled it in as growth opportunities for these companies. So clearly we it's somewhere baked into the multiples, but not yet into the earnings.
Okay. Fair point. Noted. I saw some stray announcements around power for sure, but yeah, you're right. Some of these things have been baked in as well. So, do you reckon, Ganeshram?
Just give you a number.
Yeah, please,
Sorry
please. No, not at all.
Give you a number. Over the next 3 years alone, our assessment is India will do about 10 lakh crores of capex in power alone. This number was nothing, literally nothing, any of the last 10 years, 3-year periods.
Got it. Okay. Okay. And just before we take that break, Ganeshram, the capex the capex on power, right? Do you reckon that the plans, as we understand from the government documents and the stated intent from many companies as well, is that there is a lot of renewable capacity added up, but at the same time, thermal isn't going away. And maybe near-term thermal capacities might get added up because we are looking at some serious power deficits in 2024 and maybe in the very near term. So will the capex be led by thermal power capacity addition, or will it largely be led by renewable? I'm just trying to understand for the viewer currently to know which ecosystem will flourish more over the course of the next 24 to 36 months.
All of them, but thermal is always scale.
Okay. Can you explain
Thermal
that?
has much more impact on Indian companies.
Okay.
The supply chain has more Indian suppliers supplying for when it comes to thermal, and it has bigger implications on markets. Renewables have a large imported element.
Okay. So thermal will have, all will do, but thermal will have a larger impact on the Indian ecosystem versus renewables per se. That's the point you are making. Okay. Fair call. And I heard you mention about steel as well.
Yeah.
Will the steel capex be dependent grossly on how well China turns up its numbers, or could it happen independent of that?
You look at India's steel prices, they're way above Chinese prices. Okay. So I don't know if, I think it can be independent because there is some level of protection which is being given to the Indian steel manufacturers, and their capacity utilizations are quite high. So we will see steel sector capex come almost independent of how it can play out from China. But yeah, we will watch China too, no doubt. But I think the capex decisions can be independent.
Um, we shift focus to some recent developments as well, and let's shift focus to the banking space. HDFC Bank reported Q1 numbers, and they looked a bit soft from what were expectations were. Harsh, in fact, joins in to tell us just how soft they were. Harsh, good morning.
Hi, good morning, Niraj. So absolutely flat in terms of deposit growth. That was the key number, Niraj, that the street was looking out for. Of course, very high base of Q4 FY24. 7.5% sequential was the growth number at that point. And therefore, likely on the higher base, flattish growth, but the street not impressed at all. And I'll come to why that will likely be the key. But before that, on the advances front, either not the best news. Sub 2% in Q4 FY24 sequential, followed by a negative 0.85% kind of number for Q1 FY25. That again does not signal the best kind of growth from a loan book perspective either. So somewhere HDFC Bank seems to be losing market share, especially on the advances side of things, largely because deposit growth isn't catching up. What's the key now? What's the possible three key levers which investors are looking out for? One is your loan to deposit ratio shrinking. It's been flat over the last 2 quarters, and therefore a likely shrink there could change the direction in the way in which investors are thinking. Second is that should have a trickle effect on margins, and therefore any margin improvement, any signs of margin improvement could likely be a positive. And last will be your ROE and ROA ratio scaling back higher and good EPS growth. So those are likely some of the factors which investors will be looking out for.
Thanks for that, Harsh. Ganeshram, I'm not asking for a call on HDFC Bank, but could a performance of one bank be isolated to that one bank? Do you expect banks to come out with a decent quarter, or is it difficult because a lot of hope at the current valuations that we have is also laid out on earnings momentum continuing, whatever the number may be, but the momentum continuing?
So we think credit growth will slow down, okay, for the system and for the large banks. Over the course of this year, we think it can further slow down. In excess of 15-16% credit growth is unlikely to sustain even in the current year. Deposit growth can pick up, especially because the system will now start seeing the accumulated government's cash balances till elections getting now spent out, coming back into the system as deposit growth. That can, so at the margin, deposit growth in the second quarter and thereafter can start picking up. But we are still quite cautious on margins. Even credit costs can are unsustainably low currently. It can mean revert. So we think the best of ROA profiles of most banks possibly has been seen, and the valuations are not demanding, which is again another part of the caught between a rock and a hard place, because banks are opposite of what we normally like stocks to be, which is we generally like low balled earnings and high valuations. That's the construct we like, because we know earnings will catch up. Now we are at opposite. We are actually seeing earnings are high and valuations are attractive. Okay, so that can be a kind of a pull, and you might want to say that, hey, things can get weaker, but it's in the price. Okay, and we may fall into that trap on banks. That can be a live risk, but still we do believe that the earnings picture, growth, margins, credit costs, ROAs and ROEs, the March quarter was possibly the best.
So, Ganeshram, from a pure valuation perspective, just trying to understand, are you a bit circumspect, or do you reckon that valuations themselves might come under question and earnings might make the valuations seem a lot more expensive than what they are right now?
Yeah, for almost every other sector than banks, that is actually the truth. Because when you break up the earnings profile, right, there are maybe 8 drivers. Okay, you can say, will it be market share led volume growth? Will it be industry growth led volume growth? Will it be a pricing improvement which can come? Can it be a product mix improvement? Can it be raw material prices further going down? Can it be operating leverage? Can it be financial leverage? Is there anything hidden as some subsidiary loss making segment which can turn around? When you weigh all of these across our entire coverage of 250, 270 stocks, what we are coming to is uh, almost all other drivers have played out over the last 3 years, except industry-led volume growth. Okay, uh, market share gains, we don't see too much upside. RM prices, basically gross margins or pricing power, consolidation-led benefits played out. Operating leverage largely in the already in the base. Now industry needs to show volume growth pickup. Can more cars be sold, more houses be built, more capex be done, more two-wheelers get sold? So you need the industry growth dynamics to pick up. For that you need a very strong macro, and for that you need strong credit growth. For that you need the government's capex to be quite high, or government spend to be high. Keeping all the first points I mentioned, I think where there can be some scope for downgrades in earnings, and the valuations don't leave too much room for even a moderate downgrades. Valuations are penciling in almost error-free earnings expectations built in. So that's where we are confusion is also coming, that there isn't a lot of margin of safety in this market, and there can be need for margin of safety inbuilt into the character of earnings profile. That's why we have kept a portfolio construct which has where quality management have been, we are increasing the proportion of them, and increased proportion of cash in the balance sheet, in our construct of our topics, and also have cyclicals, like industrials or autos or property related stocks, some segments of financials as well. We have kept the proportion, so we are trying to keep this barbell approach, keeping this kind of a likely scenario. So we need to prepare for either a kind of a binary outlook actually.
Okay, my final question, and your note speaks about that welfare tilt as well. I'm not calling it welfare, Ganeshram, but if there is a government thrust on rural and agri in order to revive it ahead of 3 key state elections or however, what is that resultant impact? Because one is for the macros to do well, but not in our hands. Two is for a specific set, which is a policy for a particular sector or a theme working from the government, even if the macro by and large is not all right. So if the government gives this thrust on rural and agri spend, can it have the potential to change the lifeline for select pockets within the equity markets?
See, don't just look at it as rural. I think their lines are blurring between urban and rural. Okay, it's no longer as black and white as it was before COVID. So I think we could easily fall into a trap and get because we all thought over the last 4 years you would have thought rural is not done well, but tractor sales were very good. So it has not happened in the past, right? So it's not so straightforward as you might want it to be. But at a broader level, consumer, after searching for answers, we still believe that the household, the mass households, okay, I'm not worried about the top 5 crore households. I think their balance sheets are in household balance sheets are in great shape. I'm not too worried about the bottom 10 crore households also, where I think government will always take care, and it's not like consumer companies heavily depend on that segment for growth also. My concern is the middle, okay, the 15 to 20 crore households in between. That segment has not seen incomes more than expenditure, and I see debt has gone up there in that segment. Okay, and especially in the last 3 years, unsecured personal loans, credit card outstandings, that segment has seen leverage levels on the rise, and in my view, that's going to slow down, and that's why I said credit growth will slow down, and lenders will moderate there. Bank lending to NBFCs are moderating, banks lending to retail is moderating. So this can have an implication on mass consumption in that category. I'm also watching how IT sector or in general the whole GCC IT sector jobs play out, because the trickle effect of IT hiring is very high, especially in urban consumption in India. You know, in Chennai, Bangalore, Hyderabad, Pune, maybe even in NCR to an extent. Not Mumbai, okay. So markets, you can look at Mumbai and I have a different answer. But these cities and maybe even the trickle effect next towns like a Coimbatore or a Vizag, there is a lot of IT hiring led trickle effect into the economy. For every job in IT, 3-4 jobs get created outside IT. So IT has not been adding jobs. You know, it's six quarters, maybe now seventh quarter or in a row where IT might have shed jobs. So I'm watching that to figure out if what can be the implication of this as well. We also watch for as a crude proxy a BSE 500's employee cost. It is growing at the weakest pace, and if you adjust for some of the pension provisions that state-owned banks made in last year, if you exclude that, because that's not cash in the hands of people, it's actually quite weak. And I so for us, even though there can be a narrative starting in the markets that government might now want to take a more measured stance, there can be an increased tilt towards consumer benefit. We still think the household balance sheet needs to be I'm not saying repaired to make it sound too much, but it needs some bit of improvement, okay, before consumption starts picking up. So we still remain wary of mass consumption households expend or discretionary spend coming from there, especially unlevered consumption.
Points well noted, Ganeshram. Fabulous points. Thanks so much for bringing these to us, and thanks so much for talking to us today. Hopefully we get out of this conundrum of being between a rock and a hard place soon. Either ways, either direction. But thanks for joining in today.
Pleasure's mine, Niraj.
Right, that's the view from Avendus Spark, Ganeshram Jayaraman. On the note that the markets are a bit skittish, we wrap it up on this leg of Talking Point. Thanks so much for tuning in.